Welcome to Indianomics. This is a banking special. Banks have been facing pressure on their margins because their lending rates have fallen because of the repo rate cut. You know, their lending rate is linked to repo rate. But the cost of their deposits has remained high. Bankers and Reserve Bank are hoping that as the Reserve Bank floods the market with liquidity, deposit rates will fall. But that hasn't happened so far. It's 2 months since the repo rate was cut. 7 trillion rupees have been infused, but deposit rates haven't fallen. Now, the other reason why deposits are staying high is Indians are saving less and less via bank FDs. Instead, they are preferring mutual funds. The mutual funds also keep their money in banks, but in the current account, from which they are frequently withdrawing for transactions. Such current accounts are unstable, so for longer-term loans, banks are forced to raise one-year money at 8% through certificates of deposit, CDs or bulk deposits. The question we are asking today, therefore, is, given the new savings pattern of Indians, is it likely that bank margins will continue to remain under pressure and never return to the pre-2022-23 levels? Will loan growth also be under pressure for want of stable deposits? In short, is the best of margins and loan growth behind us? For all these questions, I'm joined by three veterans: Dinesh Khara, former chairman, State Bank of India, S.S. Mundra, former deputy governor and a former chairman of BOB, Deputy Governor of the Reserve Bank, Srinivasan Varadarajan, Chairman of Union Bank and a veteran banker at Axis in his previous avatar. Gentlemen, thank you very much indeed for sparing time for me. I'm deeply grateful. Let me start with someone whom I can call a practicing banker, Srini Varadarajan, who is still the Chairman of Union Bank. Srini, what is your sense? Is this shift in savings behavior going to permanently impact banking as a business? As Uday Kotak puts it, that there is a challenge to the business model.
I think you've got to look at it from multiple perspectives. Right? You're looking at the last couple of months, which has been, which everyone knows is the busy season as far as the banking system is concerned. And the maximum growth happens in that quarter. I think looking at it as a signal for what is deposit rates is not necessarily the right indicator. We will see some of the deposit rates coming down this quarter, which is typically a sort of a lean season. So that is one aspect. The other aspect which you touched upon is that whether the peak of bank margins in terms of NIMs is behind us, and is that something which we need to factor in going forward? I would think the market to a large extent is reflecting that, even though every analyst on the street is to some extent overweight banks or recommending banks. I think the banks are struggling to perform over the last couple of years. That, to a large extent, is due because of consolidation of market share amongst few banks. If you look at the last couple of years, incremental market share of 3-4 banks is above 50%. And therefore, every other bank is forced to fight for the remaining piece of the pie. And that, which means that when you're looking at bulk deposits or CD rates, when rates are set at a high level, others typically become price takers. And therefore, costs are not coming down on the deposit side. As you said, CASA and retail term deposits are growing at a steady pace, but nowhere to the pace which credit growth is happening. And therefore, NIMs continue to be under pressure and will continue to be under pressure.
Okay. Well, let me get Mr. Khara in on this. Clearly, he is a price setter. I mean, State Bank is one of the guys who's doing the consolidation. Mr. Khara, we don't see rate cuts even from State Bank. And liquidity aplenty has been given. A CRR cut in December, almost 7 trillion rupees by way of OMOs, swaps, you name it. And now we have ended the quarter with a little bit of a surplus, actually, in the interbank system. What is your sense? Is there a permanent problem? In spite of liquidity, will this deposit cut not be commensurate with the lending rate cut?
Well, I think I tend to agree with what Mr. Srinivasan has just mentioned. There are different segments of the economy, and when it comes to the seasonality of the deposit and the credit of the economy, there are various dimensions. So when it comes to deposit, particularly, when we look at the credit deposit ratio for the system as a whole, which is around 80%. So naturally, when the credit deposit is at 80%, so there are many banks which are clamoring for the deposit. And similarly, when it comes to the price setters also, what you mentioned in terms of, banks like State Bank of India, who are witnessing about 12% plus growth in terms of the loan book. And also when it comes to deposit, they have to maintain the pace of the deposit growth. So they cannot be out of the market. And that is the reason why perhaps they have not seen the reduction of interest rate in the deposits.
Okay.
There are, we look at it from the point of view of the structural changes, a couple of structural changes which have happened. We have seen that, for last 10, 12 years, there is significant growth in the mutual fund AUM.
Yes.
It used to be about 12 trillion. Today it stands at about almost about 67 trillion. So that very clearly means that it's one segment of the society who have become saver in this particular situation. They have only seen the upside of the mutual fund. Only for last about 2 months' time, they have started witnessing the reversion to mean.
Yes.
And that is one of the reasons why probably you would have seen that, when it comes to SIP, whether those SIPs have been paused or there have been stoppage of SIPs. So I think this is one phenomena, what you mentioned, whether deposit will go away and people will go for only for the mutual fund. Perhaps this is one area where now the behavior will undergo a change.
Yes.
This generation of the savers will probably have much more matured outlook. There will be allocation principle which they will be applying. They will be going deposit and as well as for the market instrument, depending upon the risk appetite.
No, that's the point, sir. My father saved only on FDs. Whereas I would assume that, and I am on the threshold of retirement in a few years, I would perhaps be more, different in my asset allocation. So, Mr. Mundra, my more elementary point, I take what Srini and Mr. Khara are saying, seasonal, slack season, busy season, all that is taken. But isn't there a permanent issue that lazy deposits era is over? And therefore, bank margins won't be what they were. Banking business won't be as easy as it was.
Okay. Interesting point, Latha, and both Srini and Mr. Khara has made very relevant point. But let me start with, there had been certain narration, and you have also mentioned recently. Number one is about, looking at that you raise deposit 8%, where the cost ultimately comes near to 9%, and you land at 8.5%.
Yeah.
Similarly, there had been narration that CD ratio is running at 80%. Now, what I would like to argue that these are a very valid point, and they indicate to a long-term trend, but they are not as binary as we can very simplistically look at them.
You're referring to the, I think we should run the Uday Kotak tweet. I think you're referring to that. That 8% cost and 9.5%, 8.5% home loan.
Yes, I am referring to that. The fact remains that while you are raising deposit at 8%, you are also having the CASA, which is maybe 3 to 5 or 7% in saving rate and zero cost at current account. So ultimately, you look at blended cost. Why I'm telling it is not as binary. Similarly, you are talking about that a home loan is given at 8.5%, but at the same time, there are loans which are also earning 11, 12%. So again, you have to talk about the blended yield. The point I am trying to make, Latha, that with all this, even with the trend which is little declining, but if you look at the NIM of Indian banks, they are still very high if you look at globally. So there is a room, and there is a atmosphere is building up where I agree these NIMs have to come down to a level which is more matching with that. So I agree with Srini that couple of months or 3 months did not to be taken as a permanently lasting trend. But my opinion, fact remains, this is a high time for Indian banks that they will have to look at the credit side and move away from this model of, getting into wedlock with an asset. Means you underwrite an asset and then till maturity it remains. It has to be originate and distribute model. And for originate and distribute model, you have to have an efficient market. It was not there at all a few years back. Today, there are avenues are available. But fact remains that lot more is to be done, and banks have to be prepared for this change where the NIM would be under pressure, NIM would be declining, and they would have to learn to recycle their assets and do the new underwriting.
Okay.
As well as one last thing.
Okay.
One
Sir,
cannot
sir,
only
can I
think
come
of-
to you? Can I come to you
Yeah.
in a minute? I'll come to you in a minute. I take your point entirely that one point you make, yes, the era of lazy deposits and therefore high NIMs is under challenge. And secondly, that now banks have to circulate their assets, buy and sell their assets a little more. I'll come to that in a minute, but I wanted to ask Srini another thing. You know, the constant criticism, I mean, I get even trolled for that ultimately money remains in the banks. And therefore, why are you all cribbing? You tell me why it is not different. That money coming as FDs and money staying in the current account of a mutual fund, why are they fundamentally different?
Clearly, as you initially said, the behavioral analysis indicates that, yeah, the current account deposits are volatile and you cannot rely on them for long-term lending. So the point one needs to understand, and one possibly the market or the regulator needs to sort of mandate, is that banks need to disclose quarterly average balances of all these deposits, whether it's current accounts, savings accounts, retail term deposits, and bulk and CDs. Because the composition of this is changing. The liability composition is changing. Even though a year-end number looks like X, actually the average balances are not that. And the composition of current and savings accounts in the overall liability profile is coming down. The system is growing credit at a faster pace than the average balances of CASA are growing in the system. Therefore, even though these are low-cost deposits, their share in the overall liability profile is coming down. Therefore, the cost is getting pulled up. So structurally, the NIMs are actually declining, and that is the truth, and that is going to continue. And I agree with Mr. Mundra that, yeah, banks have to be prepared for lower NIMs. I think whether you call it lazy banking, whatever we call it, I think the CASA profile of banks and as a percentage of the overall liability is coming down on an average basis. That has implications for cost of funds, and that has implication for NIMs, and that is not going away.
Okay, I was going to put that last line to vote. Are NIMs structurally headed lower? Srini and Mundra have already said yes. Mr. Khara, where do you stand? Just yes or no. Are NIMs structurally lower?
I would say that if at all you're looking at NIM of 4, then perhaps yes. If at all you're looking at NIM of 3, then perhaps no.
Okay, I will take it as 2.5 out of 3 votes in favor of the idea that margins are going to be a little under pressure compared to the past. We have to take a break, and after that, I want to ask you whether the regulator and the tax authorities need to change some rules. After the break. Welcome back to the special Indianomics, where we are discussing whether India's banking model has been challenged and is looking like changing and becoming tougher. I've been speaking with Mr. Dinesh Khara, Mr. S.S. Mundra and Srini Varadarajan. Gentlemen, thank you very much for your patience, for staying on. My next question is, what can the regulator or what should the regulator do? Mr. Khara, the EBLR, External Benchmark Lending Rate Rule, the Reserve Bank brought it because banks were not passing on the rate cut even after RBI announced a rate cut. So they said your lending rate, many of them, will be linked to the repo rate or the T-bill rate. But the cost of funds, the deposits are not linked to anything. Do you think EBLR needs to be refined? Do, say, savings deposit be linked also to repo, something like that?
No, actually, Latha, there was a situation where there was an effort made by banks to link the deposit rates with the external benchmark. But what we have seen that, the market does not respond to that. And normally it doesn't really work out well. So that is the reason why perhaps, and also we have to acknowledge the fact that when it comes to savers, that community is very broad-based. There are very common men who may not like to have that kind of a risk sitting in their deposit book. So this is I really wonder whether it will be a success or not.
Okay.
But I think what you mentioned, when it was introduced that you have to link up your loan book to the EBLR, then perhaps, that can be revisited maybe.
Exactly. That was going to be my question. Srini, do you think, therefore, loan book could EBLR be rejigged? Because it seems to impact only one side.
I don't think so. I'm not understanding why that should be the case. I think EBLR is now reasonably well established.
Okay.
I think it to some extent improves transmission. See, the whole thing on the liability. See, I think the liability side starts first. I think the license to grow for a bank comes from its ability to raise deposits in a sustained, robust manner. And I think that should be the fundamental principle behind growth in any bank. If you try and grow the asset side at a pace which is much faster than what your sustainable deposit growth is, there is always going to be a problem. And therefore, banks have to calibrate their growth on the asset side based on how their deposit profile is growing.
Okay.
If you try and grow assets and then try and search for deposits, you will end up sort of weakening your liability profile. And that to a large extent is what we are seeing in some of the smaller banks. So the thing is, I don't see any reason to tinker with the EBLR. I think what we need to do is to try and make sure that the liability side growth to a large extent drives the pace of asset growth. And as long as that is there, I think it will work. By growing the asset side faster is when I think the risk lower NIM sort of increases substantially.
Okay. Well, there are some banks, of course, with very stable deposits, salary accounts like Mr. Khara's bank. And so they can have the ambitions of high growth. But
That's what I said, Latha. Yeah. There are few banks which are on an incremental basis taking away the lion's share of CASA as well as retail term deposits because of their ability in terms of digital engagement and various other things they have in place in terms of customer profile. With the result that every other bank becomes a price taker and therefore they are in a very difficult situation.
Well, Mr. Mundra, I want to come to you because you brought the very important point that banks have to churn their assets now. You can't give the loan and hold it till maturity. You have to manage the book. Do you think the regulator also has to become a little open to banks depending on wholesale funds and managing the liability part also? The fixation with CD ratio probably, as it is, in the D of the deposits, they are not including NABARD refinancing and, the D is a little underestimated. So do you think separately, the RBI also has to become a little open to people taking bulk deposits and certificates of deposits? Nothing wrong. We have all to become marketized.
Okay. Number one, I think whenever there is a little sign of stress and the narration goes back that then our regulators should do something.
Okay.
I think all the entities are mature enough. Market processes are well established. To my mind, one, I have already mentioned that you have to manage your credit book more efficiently. You have also to become more efficient in your asset liability management. Okay. Now, if you look at it, I mean to say, you see there is something like behavioral pattern in CASA deposit, which is allowed by the regulator, right, for your ALM plotting. Now, if you look at the behavioral pattern of your CASA deposit, you also look at the behavioral pattern of your wholesale deposit, you reach to a core portion of your deposit, which you can call as a core portion. You put some allowance there also further, little bit as a cushion. That core portion is what you should use for your long-term lending. Match it. And then you have the short-term lending and the consumer loan. And that long-term book also which you create, then you should be able to churn. I think it will be a virtuous cycle. But what I am trying to say, I agree with all the gentlemen, with you, the whole structure, it has to go a structural shift. Now, there has been argument that this preemption should be reduced or other the regulatory cost should be reduced. Okay, fine. To my mind, that is not a lasting solution. That is a band-aid. Okay. Regulator do it today. Within 6 months or a year, everything will be absorbed and you are back to the same place where you are. So I think what we should look at is the more lasting and root cause solution rather than every time clamoring for that, regulator should come with some crutches and provide the help.
Okay, I want to quickly try and get two questions. Mr. Khara, does the government have to rethink taxes? I mean, debt is really getting a bad deal compared to equity. And the corporates also need debt capital. They can't only manage with equity. Is there a rethink needed?
Well, I think and particularly in the context of the deposits also, there is a scope, because when it comes to deposits, it is subject to tax on accrual basis, whereas when it comes to capital gains, it is subject to tax on the cash basis.
Yes.
So I think that is one area which probably needs to be addressed. And what you mentioned that, when it comes to even the long-term capital gains also, for a economy which is aspiring to grow at much faster pace, we would certainly need the debt as well as the equity both. So the gap between the
Capital gains.
capital gains probably it needs to be re-looked into. So I think there is a scope which can perhaps be looked into depending upon the fiscal room which is available, can perhaps be looked into.
Yeah, I guess there are a lot of votaries for low capital gains on equity, capital gains tax on equity, but there are not so many people supporting debt. Final question to you, Srini. The usual cry is when animal spirits are there, loan growth will come. After all, every loan creates its own deposit. Therefore, this argument is only because you are under pressure, you're bringing all these arguments. Once the animal spirits come, deposits and loans will both grow. Is that a good argument?
So I agree. I think the growth drives credit rather than credit driving growth. So the whole thing of trying to say, give more liquidity and credit growth will happen, and therefore growth will have an uptick. I don't agree with that. I think growth, when it happens and animal spirits are there, automatically credit will be driven up. Never have we seen banks short of money when there is demand. Just by having liquidity and money and trying to push credit, I don't think so we'll achieve growth. So it has to be that investment happens, growth comes back, animal spirits are back, automatically credit will grow and banks will be finding the deposits in whatever form.
Okay, fair point. Let's end on that optimistic note. Thank you very much, Srini, Dinesh Khara and Mr. Mundra. Very important takeaways. One, growth actually solves a lot of problems. We crib when growth is not that good. Second, there's no denying that margins are under pressure. It's not going to be as easy as it was when FDs were the way in which people saved. Third, banks will have to get more active in the way they manage their asset book, and perhaps the regulator will have to get a little more tolerant with respect to banks relying on wholesale funds. And finally, does the government have to rethink on this very big gap between capital gains tax on debt and on equity? Thank you very much, gentlemen, for a very interesting conversation.
Thank you.
Thank you. Thank you, Latha.